What does all this mean? Let's talk about managing your money now. One of the things that you'll hear a lot from advisors and television, there's plenty of articles written on this, is, well, you can't time the market. Because if you miss the 10 best days of the market, well, you just give up all of your returns. What that blue line shows you is if you miss the 10 best days of the market, and they're right. So if you invested money and you are out of the market whenever the 10 best days occurred, that was your return. Not so good. This is basically being invested in the markets and missing the 10 worst days. If you could just avoid the 10 worst days, rather than worrying about catching the 10 best days, you're far better off. The green line is the actual just being invested in the markets. But you can't time the market. I don't have to time the market. I'm not a day trader. I'm not trying to be in. I'm not trying to be out. All I'm trying to do is avoid the potential, the possibility for having a major destructive drawdown in the market, because 95% of the time, investors are doing what? Making up previous losses. If I'm wrong temporarily, I can get back in. This is the problem with the bull versus bear argument. Those are two nomenclatures that need to leave your vocabulary if you want to be successful long term. Being bullish or being bearish has nothing to do with your money. Let me give you a scenario. I have $100,000 invested. What's worse? Going to cash and being wrong and the market goes up 2% without you, or having $100,000 going to cash, being right, and the market declines 20. What's worse? See, the problem is with this whole nomenclature of bull and bear, the whole idea is for Wall Street to keep you invested all the time so they can collect a fee from you. That's how they make money. They've annuitized their business. You know, when I was growing up and with my dad back in the, well, I won't tell you how long ago that was. But there was a guy that lived down the street. He was always walking around with the Wall Street Journal. He was a stockbroker. Worked for Merrill Lynch. Great guy. And this was back in the day when actual stockbrokers actually brokered stocks, right? I mean, he was a well-respected guy, suit, tie. Everybody in the neighborhood loved this guy. He was awesome. Tell you great stories about companies, things that he was doing. But he worked with his clients. They bought stocks. They sold stocks. He charged them a commission, but he managed their money. Well, the problem with commission-based business is like any sales job. Anybody here in sales? Okay. The problem with sales is you've got to go sell something every day. If you're a salesman, you've got to go kill something every day so you can eat. Wall Street doesn't like that, because if I'm dependent on my commission-based brokers to go out and sell a new stock every day, sell the next idea, sell the hot pick, my revenues fluctuate. They're all over the place, depending on what's happening in the markets. During market crashes, nobody wants to buy anything. I can't sell anything. So in the early 80s, Wall Street said, hey, we got this great idea. Let's create this thing called a mutual fund. We'll get all these people to invest in the mutual fund, and then we'll charge them a fee. And then this way, every year, we already know what we're going to make. January 1st comes on, we've got $100 million invested at 1%. We've already made $1 million for the year. All we got to do is go sell this year. And every year it annuitizes. It's a great business strategy. It annuitized the financial industry. This is why Wall Street makes hundreds of billions of dollars a year in profits, because they've annuitized their business. There's nothing, and look, I'm not bashing Wall Street. It's just the way it is. But you need to understand what the rules of the game are. So the reason that they always tell you you can't time the market, you've got to be in or you're going to miss it, is because if you take your money out of the market, they don't make any money. So the message has to be, keep your money invested. And since Wall Street's what pays for the advertising on CNBC, the same message occurs. But the reality is, as I was saying just a second ago, is that if I'm out of the market and I'm wrong, because the market goes up, I can get back in. So yes, I give up a little bit. And I'm going to show you this in a second. I've got actual data. But if I'm right and the market corrects, I'm not spending all my time making up losses. So it's easier to manage the risk in your portfolio than trying not to. And this is the point. If I can just avoid the drawdowns, this is the differential between an investment over time, which makes the difference between whether you retire or not. And yes, using those signals right there, you'll notice that you didn't get out of the market before the decline. You were up a little bit late, and you didn't get back in at the bottom of the market. You were a little bit late getting back in. But over time, you were truly able to compound returns because you weren't making up losses for 6 years of the bull market rally. Today, as we speak right now, there are people that still have not caught up to where they were in 2008. There's also another myth. This one drives me completely bananas. And y'all, a lot of y'all here are guilty because y'all have emailed me this. But Lance, can't have my money sitting in cash. It doesn't earn anything. Who cares? What's better, a zero yield or a negative yield? Zero yields can be very positive in the right environment. Here's the point, though. Cash is a hedge against risk. When you don't know what to buy, don't buy anything. The opportunity to come along and buy something are like taxi cabs in New York. They show up every 2 minutes. But trying to force a buy just so you don't have cash that's yielding nothing right now is not important. Now, don't get me wrong. I'm not saying that you should have cash for 20 years. You shouldn't bury your cash underneath your mattress. I'm not saying that. Over the course of a long period of time, 20, 30, 40 years, inflation does eat up cash earning zero. So no, I'm not saying hold cash for 30 years. But if I hold cash for a year, particularly with inflation running at basically zero, what's my risk? Waiting for the right opportunity. This is what cash did from 1900 versus the market. When I'm compounding cash, which doesn't lose money except to the rate of inflation, it outperforms the stock market over time where I'm dealing with the decline in asset prices. This is inflation and PEs. So the point is that the whole point here is that in an environment where we are today, with all the indicators that are mounting up, that we may be at a potential turning point in the market. Note, I keep saying potential, possibly. I'm not saying definitely. Please don't walk out of here saying, Lance said X. I'm not saying that. What I am saying is that there are plenty of warning signs that suggest that we may be at risk of losing money. And I don't want that for you. Holding cash at zero is better than negative yield. That's all I'm saying. Because everybody says if I invest in the market, it'll be fun. These are your bull markets. Nice, big, booming bull markets, tech bubble, housing bubble, liquidity bubble. Notice the elevation of the advances. And again, I asked you earlier, I said, doesn't this current bubble seem a little bit abnormal? Look at the elevation of advance during the tech bubble and in the real estate credit bubble versus the elevation of the advance and the length of the advance currently. Now, I'm not saying there's anything wrong with that. It just seems very abnormal as compared to every other bubble in history. Of course, there was no bubble in 1999. There was no bubble in 2007. Alan Greenspan and Ben Bernanke both said so, by the way. There's absolutely no bubble here because Janet Yellen says so. Of course, everybody sold at the bottom. And that's the big problem. So this is the value of risk management. Okay, so this entire presentation leads up to this. This is the big thing right here. This chart is in the newsletter every week. This is what I drive the 401k plan manager with. It's 3 signals. Short, intermediate, long. That's it. It's no harder than that. It's not complicated. It's not rocket science. But this drives to the heart of you can't time the market. First of all, I want you to notice, this goes back to 2007. Prior to 2008, there were 4 signals only. One in 2000, a buy signal in 2003, a sell signal in 2007, and a buy signal in 2009. Since then, look at all the signals. Have never had that before in the history of these indicators going back to 1900. That is because of what's going on with the Federal Reserve. It has increased by a large percentage the amount of volatility in the market, has made it more difficult than ever for individuals to manage their money. It's very hard for me to manage money. It's very hard for Richard to manage money. It's very hard for anybody here to manage money because of all the volatility. When you think something's going one way, the Fed comes in and does something, and stocks do something completely different. Very hard. But the point is that what this signal does is that as the short indicator gives a sell signal, it generates a buy or a sell. When the intermediate term, it generates a buy or sell, and each one relates to a 25% reduction in the allocation. That's it. It's just very simple. It's not hard to do. So this is the model's allocation from being fully invested over the course of the last year to where we are currently. Now, this is the interesting point. Because the last 4 weeks, we've had a sharp acceleration in the markets. Lance, you missed it. You missed the rally. I did, but I didn't. Because since May of last year, we've been at 50% exposure and reduced risk then. And this is the question. See, I get this. I'm missing out. I just had an email this morning before I came over here. I've missed out on the whole rally. Damn you. I know. I'm sorry. But my discipline says, on everything we've talked about, we're in the right place for right now. Is it going to stay that way forever? No. If the indicators turn back positive and risk is reduced and the odds of us making money versus losing money outweigh, we're going to increase exposure. Thank you. All right. Let me show you something. This goes back to January of last year, following the model allocation in the newsletter as we've been talking about. So, if I invested money in a 60-40, okay, so the model in the newsletter is 60% stocks, 40% bonds. If you had invested money in a relative allocation, 60% stocks, 40% bonds, did nothing with it, this is what your return looked like. This is a buy and hold return since January of last year in a 60-40 allocation. This is the allocation return adjusted for risk through Thursday. I didn't get Friday's return in yet because getting ready for here. But this is through Thursday's close. It's relatively the same. There is a $500 gap between January of last year on a risk-adjusted basis versus just buy and hold for the last year. Well, Lance, see right there, just buy and hold. Don't talk to me anymore. Do you notice something about the chart, though? How many people were feeling a little queasy in January and February with the markets? Anybody lose any sleep? See, the value of risk management is about reducing volatility so you don't do one thing. And this is the whole reason. It's not about not losing money. It's about not making money. It's so that you can sleep and you don't call your advisor up and go, get me out. Because where are you going to do that? At the bottom. Exactly when you shouldn't be. When you should be buying, that's when you'll be selling. So the point of reducing risk is simply that. This is the S&P 500. Same time frame, being invested in the S&P alone, if you were just chasing the index, the differential between being in 60% stocks and 40% bonds versus being 100% stocks is a $500 gap. But I'm an aggressive investor. Yes, you are. And if you enjoyed that ride to the downside, more power to you. For me and for people that I talk to, people that I deal with, it's about volatility. It's about emotions. And if we go back to that Dalbar study, what's the number one driver of why people don't make money in the market or underperform severely? Because they're emotionally doing the wrong things. They're buying low, they're selling high, they're doing all the wrong things. So this is the same analysis using the model in the newsletter going back to 1999. This is the return of the 60-40 allocation. Now this is assuming buy and hold. You never changed anything in the S&P in either one of these indexes. You just bought 60% in a Vanguard S&P 500. You bought 40% in the Vanguard bond fund. That's what your return looks like since 1999. You are wealthy beyond imagination. This is the exact same model adjusted for risk. Using the same signals, exactly the same thing, but you can't time the market, right? If you notice, there is no real differential between the advances during the markets when the markets are rising. All of the gap between the two are generated in two periods, 2001 and 2, 2008 and 9. The value of not losing money is far more important than making money. So again, I go back to what I said earlier about managing risk, is that if you are temporarily out of the market because you are unsure what to do, that is okay because the risk of losing money far outweighs the risk of making money. And here's one last point to conclude on that. The one thing that we all have here in common, every one of us have this, it is one commodity that we all own that none of us, once it's spent, can ever get back. And that's time. If I have 20 years to retirement and I spend 5 years of my 20-year time frame getting back to even, I don't get that 5 years back to save for retirement, to compound my returns. You know, everybody, and if you listen to CNBC long enough, you're going to hear somebody say it's the power of compounding. Compound interest in the markets. That's what makes you rich over the long term. Given that you invest at the right time and that you're out of the markets at the right time, absolutely true. But if I want to make 10% a year on my money, and I invest money, year 1 I make 10%, year 2 I make 10%, year 3 I make 10%, my average annualized rate of return is 10%. If I lose 10% in my 4th year, I reduce my compounded rate of returns by 50%. To get back to my 10% rate of return in the 5th year, I need a 30%-ish rate of return. That's why over time, the loss of even small amounts of money have a far bigger effect to your compounding of returns than what you make on the upside.